I'm just going to pass you along so we can introduce ourselves.
I'm Charlotte Harrison. I look after the mortgage products team at Skipton Building Society. Fair to say, I can completely empathise in some of Claire's opening remarks. It has been a very busy last few weeks for lenders and brokers alike, if not months. So, but yeah, my history is predominantly in the mortgage industry, always in a lending capacity.
Good.
Yeah, hi everyone, I'm Ben Williams, Corporate Account Manager at Coventry Building Society. My role is managing distribution relationships with networks and mortgage clubs on behalf of the Society. Been with Coventry about 11 years and a couple of other lenders before that, so my background very much intermediary lending.
Thanks for that. I'm Reece Beddall, so I'm the Sales and Marketing Director at Bluestone Mortgages. I've been here for about 6.5 years, doing a variety of different management roles within the company. For those that don't know, I know obviously we're a specialist lender, so we're a complex credit lender focusing on sort of residential complex incomes and credit as well.
Perfect. Right, so moving on to our first question then. If we look back at the market over the last 2.5 years through the COVID era, and particularly the last 4 weeks, what changes, if any, have you introduced to your processes to assist with service levels? And do you think that any of these will be made permanent? I'll come to you, Charlotte, first.
Yeah, so I think it'd be nice to say we had a crystal ball, but that would be definitely a fib. But we've invested quite heavily in some of our tech capabilities over the past probably 3 or 4 years. Knowing that actually with an appetite to grow the business and grow our lending arm, we needed to do that in an efficient way. So having done some of that work quite well timed when then actually the volumes have really ramped up. So things like investment in kind of automated valuation models, income verification, expanding our very important BDM team, making sure that we have out-of-hours contact centres available, because we know that not everything happens on a Monday to Friday. People do need to speak to somebody sometimes over the weekend. So I would, like I say, it would be nice if there had been all crystal ball knowing that what was about to happen, but we did know that we wanted to grow our lending, and in order to do that you really do have to be more efficient, and so that's enabled that. I think an interesting point that when I was speaking to our head of new lending a few weeks ago, just before the mini budget announcement, we were already seeing massive levels in market activity, and over the space of a week, just because of the fast amount of repricing, I think we tripled our lending in 3 days, and then we did 5 times the normal amount of lending we did in 4 days. Now, on what was our most recent record day from that, 2/3 of that was offered within 48 hours, and it's because of all the automation and efficiencies where actually you just don't need to be spending time on things that aren't adding value. So really pragmatic approach in terms of where do we spend time and what do we really want to do in terms of adding that value.
Okay, very good. Coventry, Ben?
Yeah, not dissimilar as you'd expect really. Certainly from a tech point of view, we're investing heavily in that, like most lenders are. So we're moving across to the Iris MSO platform, which is kind of part way through, and a huge investment from the Society in that, which is helping streamline a lot of processes from a processing point of view. I suppose over the last 2.5 years, a lot of our focus has been around staff. Obviously from a well-being point of view through the COVID period, etc., working from home, hybrid working has opened up a lot more opportunity for us to recruit in different areas, etc. We've moved to a BDM model where every broker gets 2 BDMs, so you have a field or a telephone BDM or both, depending on your business and what works best for you, which has been really popular. Invested in things like live chat, web chat facilities as well, which is kind of manned by people rather than kind of robots, etc. So that's been more of where our focus has been from a front end point of view. I suppose a processing point of view, particularly again during COVID and the downtimes there, it gave us an opportunity to look at some of the processes we've had in place for a long time. So small things like references and things being posted rather than emailed, and processes we had just for the sake of having them, I suppose, which has helped us streamline a lot of that stuff at the back end. So yeah, a lot gone on in the last few years and a huge investment in people mainly to make sure that we can continue to offer that kind of personal service that we're renowned for. Really.
Good, and gone online for product transfers,
Finally.
which is very exciting.
Absolutely.
If you've not discovered that, no longer 30 pages of paper,
Absolutely.
which is brilliant. And so Bluestone, Reece, what have you done?
Yeah,
What have you done?
I think we're in a slightly different world. I think just being in the specialist, so a lot of it, it's going to be different documentation we're going to request for. So, and there's that sort of manual human underwriting approach. So there is parts of the journey that we have sped up or use automation, and there is more to go on that journey next year. Whether that's AVMs we've incorporated to speed up the valuation process or any electronic ID. But that human underwriting approach that we have as a lender, we need to keep that to our core. So what we've sort of done recently, and this was probably off the back of the last 4 weeks rather than COVID, is the feedback we kind of had from some of our brokers was, naturally we're going to ask for more documents because the types of clients we deal with naturally can't fit on the high street. So we've sort of changed the process so we can get that case to an underwriter as quick as possible. So rather than it maybe going back and forth with the case manager because maybe the documentation is incorrect, we just thought the earlier we can get it to an underwriter so that you've got an educated person that making a decision on that case, and that will help speed up the process naturally. So I think in general we're probably a little bit different because we want to keep that core approach for the manual underwriting, but where we can, we're speeding up automation. So that is definitely in the plans for 2023 for a lender like us, is to go on further on that automated journey and where we can speed up the process.
Okay, good. Just staying with you, Reece, at the moment. Within the specialist lender space, what concerns do you have around funding in this area of the market?
Yeah, I mean, it's a good question. I mean, the last month has been full on. I think hearing the comments Claire said earlier about the best and worst time, I mean, I could echo that. I think it's been the most challenging quarter for me, but the most exciting quarter as well, in not trying to say that in a disrespectful way to the brokers in the room. But as far as the funding is concerned, I mean, the markets are strong. And it really depends on what the funding setup is with that lender. So there's all. I think what we've noticed over the last couple of weeks is loads more in the press talking about funding models. I've noticed it from our brokers being more educated with how it works. So I don't foresee there being any challenges. There's actually more competitors in our space since I've been with the business in the last 6.5 years. There is funding there. The swap markets has been mental the last 12 months. So just to give you some perspective, we were sitting at 0.5 on a 2-year fix 12 months ago. And then after the mini budget announcement, up to 5.5%. So that is some extreme volatility. And lenders in our space, we've been having to ride that swap market. So rates have probably been increasing I guess more frequent than when I've ever been with the business and maybe some of the high street lenders. But there is funding there. And I think now the markets have settled. So the positive news is I think in the last couple of weeks we've noticed average swaps dropped over 1%, and it's starting to become stable. I mean, I get automated notifications on swaps every day, and it's up 15, down 14, up 15. And the last couple of weeks it's been pretty steady. So markets are stabilising. I think what we've probably seen in our space, and not necessarily us, we haven't changed our proposition or restricted any LTVs, but I have seen competitors in our space being a little bit more restrictive on those 90 to 95% LTVs in the specialist lending space. And that's just, I mean, hearing all the comments at the moment about house prices next year, I mean, that's going to be a big factor for it. For us, though, I mean, we're max 85%, we haven't changed. But the market is strong still. Like I said, more competitors than ever. The markets are stabilising, so it does help lenders, be able to price and not have to frantically realise half their pipeline's underwater because the swap rates have changed 1.5% over the course of a weekend. So, I mean, as it sits right now, I'm feeling good, but who knows what's happened in the last 3 months. But it's positive and it's strong.
Good. So staying on the theme of the market and swap rates and stuff, product change emails have been phenomenal over the last month. At what level do you think these interest rates will start to settle at in the longer term? And I'm going to come to Ben.
Wow.
Crystal ball
Reece has
moment.
just touched on it. I mean, it's changed so much in the past 2 weeks, hasn't it? You know, if you'd have asked me that a fortnight ago, it would have been a completely different answer probably. So, I mean, swap rates are down. I think Reece said they were up over and above 5.5% for a 2-year swap. They're now down below 4.5%, I think, for a 2-year. So that indicates a lot more confidence that maybe the base rate isn't going to go as high as people first thought, and hopefully the consumer confidence then follows when they see the rates start to drop. I don't know, that it depends what you read, but predictions are anything between 4 and 4.5% now, I think, for the bank base rate. But it is quite volatile still, isn't it, in terms of opinion. So it certainly feels like it's not going to be quite the doomsday scenario that maybe people thought it was going to be 2 or 3 weeks ago, but maybe a base rate of about 4 to 4.5%.
Okay, interesting that you've mentioned that. So I'm just going to jump in about base rates. We're expecting a move on that tomorrow. What's your prediction, Charlotte?
Oh, prediction. Don't hold me to any, will you?
No.
I think our latest, or my latest thinking's probably 75 basis points up. I think that's probably where the market is. But I mean, trying to predict anything concrete in this market is probably a bit of a fool's game. Can I just add on to some of Ben's comments, because I think also we know that there is a lot in terms of media coverage around rising interest rates, and obviously we know that we got the 10% on question time being brought out, and we've not found that. But there's obviously a lot of hype out in the market, and understandably customers and borrowers are really, really worried, aren't they, about actually what does that mean. But it's also worth knowing that people don't generally understand, and you wouldn't expect them to generally understand that actually, from a fixed perspective, you're not really tracking base actually, because the markets pre-predict that in. So if we're looking at swap costs today when we're pricing, and we can see that actually what we're pricing on today is that future expected interest rate, then there's an argument to say that you're in that environment now. And so the question more is, subject to more volatility, actually, are we at the peak? And we don't know that, because you don't know what's going to happen with the next budget announcement. But it's almost a case of some of the pricing that customers are seeing now, and some of the products that you'll be advising on, they're baking that in already. So it's just trying to reiterate and calm sometimes in terms of that like speculative view on where things could go, because you don't have necessarily that background and context when you're just reading the Sunday papers and thinking, oh goodness, I'm never going to be able to afford my mortgage. Just tempering it down a little bit.
I certainly do hope that and I know the pricing teams do work like this, but I certainly do hope that they have priced in the potential move to 3% tomorrow, which in theory from the broker point of view should mean that we don't see phenomenal numbers of price change emails coming out then as a response to it.
Yeah, and what you find is if you get predictions that are broadly aligned with where the market has been expecting, then there's little in terms of that kind of turbulence straight after the announcement. It's when Bank of England do something completely unexpected to what the market was predicting that you see that volatility. Yeah. So, fingers crossed.
So certainly over the last few weeks with the rise in the interest rate, this has clearly impacted stress tests across the buy-to-let market, and we've seen that come under real pressure in certain areas. So obviously, Charlotte, you guys re-entered or announced yesterday that you were re-entering the buy-to-let market, which is great news. And Ben, obviously from a Coventry perspective, you've got the Godiva brand. But where do you see the buy-to-let market heading into 2023? Charlotte?
Yeah. So I think it's absolutely fair to say that there are challenges. So landlords are going to be facing even more levels of uncertainty, and understandably probably having a lot more questions than they would ordinarily do, and there'll be a lot more factors on that. So if we think about where some of the stress testing has moved in assessing that affordability, there will be pockets where actually you can't raise rents in line to meet those affordabilities. And so actually, do we see that there's more more product switching because you have to stay with a lender. It's less appealing from moving to a lender. Will you be accepted? And then that poses further questions as well for landlords on actually, is it still worthwhile for me? Do we see more of a move to limited company buy-to-let? I know that that's been discussed with a sentiment that perhaps for the portfolio landlords where it's right, that might be the case. But I think we do know that it is going to be challenging if what we see play out today prevails into the next year.
Anything to add, Ben?
No, obviously agree. It's tough, right? Stress rates have gone up, interest rates have gone up, and that means it makes it difficult for a lot of landlords to get things to stack up with the higher LTVs. So it's a tricky time. You think either rents go up or house prices come down, or a combination of both obviously might help in that world if that was to happen. It's really difficult to know kind of where. I mean, it's been a remortgage market for a little while anyway, to be fair, away from limited company buy-to-let. I mean, there have been purchases going on clearly, but it has been mainly a remortgage space in the traditional buy-to-let market. So will that continue, but maybe with more of a swing towards PT rather than remortgage possibly? And ultimately, if landlords decide to either reconfigure their portfolios or maybe dispose of some properties because it doesn't stack up anymore, then that means more property coming to the market for things like first-time buyers, etc. So it's not, the buy-to-let space will be tough until rates come back down a little bit, I think.
Okay.
Or landlords put more deposit ultimately.
Good. So I'm just going to stay with you a minute, Ben. We've just had a question in from Graham in the audience. He's just wanting to know, has Coventry seen an increase in the offset mortgages, given savings rates should be starting to go up, and obviously clients can then see an impact on their monthly mortgage payment?
Good question. So yes, we're starting to get more questions about it from brokers that have not really used that proposition before. So offset is something that we talk about a lot. We think it's probably maybe under-discussed as a proposition rather than undersold. You tend to find the brokers that understand it said it a lot, and those that maybe don't kind of steer clear of it a little bit. But interest rates going up mean that obviously the benefit of that, arguably is even greater. And you are offsetting obviously a much higher interest rate on your mortgage, which can obviously benefit the customer. So that's definitely an area we would expect to increase for those customers that lucky enough to have those levels of savings they can invest in it. But offset we see is definitely a big part of our proposition moving forward.
Can I jump in there for a second? So the offset is very, very interesting for me. So if you can tell by my accent, I'm from Australia, and in Australia the offset account is massively popular. I myself have one back home as well, and it doesn't really get spoken about. Is it because the product hasn't had its time and people aren't educated with how it works, or why is it not, like, especially in an environment like now, would that be a valuable product moving forward? Because to me, I see the value in it.
So personally, within my broker firm, we do quite a lot of offsets, but that's probably because I've taken the trouble to learn the product. You do come up against the difference in the rate. So sometimes the client will just want the cheapest product, which is generally a standard fix, and can't necessarily see the difference between the offset. But that's only personally from what I see, but it'll vary from broker to broker. Traditional thought across the UK would be, as Ben said, that you either understand it and therefore you sell quite a bit of it, or you just don't really have that type of client.
Interesting.
Yeah, but okay, so staying with you, Ben, Reece, sorry. Affordability across all lenders has tightened up over the last few weeks, particularly at that higher loan-to-value level. Now, I understand that in part this is down to interest rate, this is in part down to ONS data updating, the increasing cost of living, etc. But what areas of wider support are you thinking about from a lender perspective so that we can continue to support those home movers and particularly first-time buyers in terms of getting onto the housing ladder?
Yeah, I think it's a challenging one. I mean, especially with the environment we're in now. I mean, in the specialist market, we're having to rely off the swap rates, and I guess lenders need to bake in that to be sustainable as well. So rates are probably the highest I've seen since I've been in the UK. So that does have a big effect on affordability. I think the positives to come out of it is not, we haven't reduced any sort of LTVs, so trying to push the LTV. Affordability is probably a big priority for us to review our model to see, are we being too cautious? Obviously the FCA came out recently about the 3% stressing. Not many lenders have really come out and said they're comfortable removing the stressing in this environment. But as we were saying earlier, it feels though, we may be starting to get to that peak. So rather than maybe reviewing the stressing, is there ways we can look at some of the data we're using? So whether that's ONS, moving away and trying something, an alternative method, that's definitely high on the priority for us. But I think in this environment, affordability is probably the big thing. And I think even with the specialist lenders, I mean, I have our brokers say to us, and rate isn't really the most important thing. It's about getting the deal done and being affordable. So that's kind of probably high on our priority list to get sorted in the next 12 months, or next few months, I should say. Help to Buy is an interesting one. So that was our most popular product. So when we first launched, I mean, 25% of our volume was Help to Buy. Naturally, we've seen that sort of decrease over the remaining months. So we're quite passionate about that product. I mean, being a complex credit lender, 5% deposit, we really need to fill that void of Help to Buy. It is challenging for a lender like Bluestone. There's loads of private schemes coming out that you're seeing. And I think the challenge we're finding ourselves at the moment is that probably a bit of a journey to go on from those private schemes with education on a complex credit lender. We had the same sort of troubles with Help to Buy sort of 3-4 years ago, but we just kind of needed probably, we need some backing behind some of them and be able to sort of lend to sort of complex credit or complex incomes. At the moment, they're quite sort of straightforward and more high street focused. So for us, I think, as a lender, we want to, we're exploring these different options at the moment, trying to find the right fit. But I think with the void of Help to Buy now ended as of yesterday or the day before. So I guess our sort of ambition is one, to work on the affordability model, and that's going through now. So that we will hopefully come out with something new in the coming months. But then also find what is that Help to Buy replacement for first-time buyers, because as my comments mentioned earlier, I mean, if house prices are predicted to sort of go down next year, it's going to be hard to be knocking on the door for funders for 95% of funding unless we can sort of, get involved with the scheme. So that's going to be pretty critical, I think, moving into 23.
Okay, and again, I guess to Charlotte and Ben together, both of you play quite heavily in that first-time buyer market. Yeah. What projects, if any, that you can tell us about are in pipeline to look to fill that gap?
Yeah, well, so I'm happy to share. We in terms of response to Help to Buy, we entered into 95% new build market last July, I think. I'm right in saying that. The years seem to all blur into one, so I think I'm right with that. And we'll continue to be a really keen supporter of that market. I know that helps with the deposit barrier, maybe not in terms of stretching the affordability. I think in terms of supporting the market, this is where it's really helpful to understand actually all those probably more nuanced policy areas that actually can make a big difference. So, for example, the income booster, joint borrower, sole proprietor, longer mortgage terms. Do you look at the longer term fixed? Might not appeal, but could it help? Family discounted purchase, you gifted, all of those elements actually that we've invested in over the past few years, and then you continue to learn as you see. Right, well, we're starting to see more of that customer base now. What can it tell us? How do they perform? How do they act? And actually, is there then scope to push a bit further and continue to make those improvements? We looked at the 95 shared ownership, so we're really keen supporters of the shared ownership market as well, and we're part of the first home scheme as well. So there's quite a lot of breadth in terms of how do we help more in terms of first time buyers, but it is also, we know that the next year will be challenging, and so we probably need to think again a bit differently as to what else we can do.
Yeah, again, more or less similar. As a mutual home ownership, and supporting home ownership is massively important, strategically important to us. So, supporting first-time buyers in any way we can is massively important. We've made changes this year to our first-time buyer proposition, similarly, wider gifted deposit sources, longer terms, that kind of thing. We're always looking at different schemes in the new build world, and the big part of the green will probably play in mortgages moving forward as well. How can we support home ownership and more energy efficient homes, etc. So expect more of that, but it is, again, as Charlotte said, it's difficult to see mainstream lenders widening their credit policy massively in a world where potentially house prices might be coming down and interest rates going up. But equally, we're still lending at 95% LTV, for example, so we are still absolutely supporting those markets. Yeah.
Just add as well, not necessarily on product or policy, but we've also been doing quite a lot recently about kind of first-time buyer research and myth busting and understanding, and you'll be pleased to know that as part of that, when we've run events and talked to a lot of first-time buyers, we tell them to come and seek advice. But I think there's something around trying to start that journey a bit earlier, because people don't know what options are available to them. And I think sometimes if you're not engaged in that process, it's almost losing a trick. So from a business element and actually opportunity to grow that, speaking to would-be buyers quite early on in the process, we think is really, really, really valuable, and actually nurturing that through, because then that's how you're building your relationships and developing that for kind of like more longer term opportunities. So we've been doing a lot of that as well to try and support and encouraging them to come and seek independent advice.
Very good. So I just want to move on and have a broad sort of conversation with regards to conveyancing and how this links into the lender journey. Conveyancing in general is taking upwards of 20 weeks at the moment in the purchase market. This traditionally, way back when, you would have been 12 weeks. Pre-COVID, it was sitting at about 16 weeks. What, if anything, do you think lenders can do to assist that process? And is there anything more you guys can do to shorten that gap from app to offer? I'll go to Reece first, please.
Yeah, well, I mean, one of the processing I mentioned earlier that we've done is to try to get the case as quick as we can to an underwriter, just to try to speed up that front end process. Probably going to be more typical for a specialist lender than a high street. I mean, we've kind of had an update with our funding model as well, so we're now hedging earlier on. So we're putting a lot of energy in trying to get that case to application received straight away to speed the journey up. So whether that's education for brokers on how to package cases, just simple reminders of outbound calling from some of the sales team as well. But in terms of that app to offer as well, I mean, we have sort of internal targets of how many times sort of underwriters should touch a case, so they should be able to make a decision pretty quickly to speed up the processing time. I think once it sort of hits that offer stage, that's when you start to feel. I mean, we've seen obviously you just mentioned the stats there with the conveyancing getting pushed out, and we've certainly seen our average offer to completion time increase. So yeah, I guess from the lender's standpoint, look, all we can be doing, I guess, is following up, chasing, but we definitely have seen an increase, but not a massive, not a drop off, I should say. So we are seeing our offers complete. They are just taking some time to go through.
Good. And similar with you guys?
Yeah, I was just going to say, just probably add that there's probably, in terms of speeding the process up and making it more efficient, it's probably limited in terms of what you can do once that offer's gone and it's out there. But I think there's more around, if we know that actually the pipeline and the funnel, if you will, is huge, and there are going to be bottlenecks and it's going to take lengthier amounts of time, as lenders, probably what we need to be really clear on and try and support as best as possible borrowers is what does our offer validity period look like, and actually are we doing the right things there? So for example, offers as 6 months as standard, potential to extend for another 6. So because people are understandably worried, saying, well, we might not be completing for 6 months because of how things have been pushed out. What does that mean? Am I still able to access the product that I selected, 5 months ago?
I suspect that's one of the top 5 questions in the industry currently, Charlotte.
But I think, having those conversations and making sure that you've got from my perspective, a customer-centric lens on that, and actually doing as much as you can to support, knowing equally that it does come with challenges from a lender's perspective as well, because we know that the swap costs have been very expensive, and it's sat there, and we're paying for that.
And you have that challenge. Like, you almost get a case with, especially with the new build cases. Our offer validity period isn't as long as a high street lender, but you're getting cases that are coming up to their expiry, and the rate that we've got on the mortgage offer is nearly 1.5–2% cheaper than what the swap cost is right now. So it is a challenge that the lenders are having to sort of navigate at the moment.
Yeah, definitely. Just coming back to you, Charlotte, we've had a question come in from the audience. You mentioned earlier that Skipton are part of the First Home scheme. Are you able to share with us what the take-up has been?
So it's been a slow start and slow burn, but that's because of the number of units that have been available. I think from our perspective, we knew that, so we knew there was only a handful of sites, and that we were expecting that to be a really slow burn. I think we've done, probably about a quarter of them, so we're pleased. I think now we know that for future expectations, we know that Help to Buy is ending or ended, and therefore from what we've been told from Homes England, there's the intent to now really ramp up the build and developments on that. So we should start to see some more coming through. But I'd say early days, it's been small volumes, but I think it's been working well for the right people, and probably much needed.
Okay, good. And then just going back to the conveyancing piece, I'm going to come to you, Ben, specifically. Free legal services are stretched to the max currently, with some even refusing to speak to brokers, which is very interesting indeed. But do you ever see a time where Coventry may consider introducing a cashback remortgage so we don't have to use a free legal provider?
It's a closed question.
Closed question.
Question. Yes, yeah, I do. It's on a long list of things to improve our proposition. A number of reasons why we've not done it before, one of which is product launch capability, I suppose. So by having a cashback option as well as a remortgage option, you effectively double your product range, which isn't without its kind of resource and challenge in terms of changing your products, etc. So that's being worked on. And yeah, it's absolutely, it's a want from brokers. So yeah, we look at it regularly, and I think, yeah, we definitely could. In terms of free legals, yes, obviously they're having their challenges. A cashback isn't always the magic solution to that, because clearly other conveyancers are having their challenges at the same time. So, yeah, but yes, we are looking at it. And if there are challenges with our particular own free legals, we have escalation processes and etc. to resolve those things as well. So, yes, is the short answer.
I would just jump in as well and add, because this is a question that we get from our intermediary development team a lot, and we have had the options of remortgage products with effectively the cashback amount that you would want from a legal's perspective, and we periodically will have them in and or out of the market. Now, we get asked the questions a lot, but actually when it comes to it, we don't always get the level of take-up that you would expect to say we get questioned about it so much. So it's interesting that we hear that, and yet actually when we do put those products out in the market, the take-up's relatively low.
We do some similar research with the sourcing systems and what's sourced on a remortgage, whether people are sourcing cashback or sourcing free legals. And still the majority of people do source for free legals and not cashback, which is another reason why, even though a lot do ask, that, yeah, the majority do still.
That's fascinating. So I'm going to ask the audience now then, if anybody's got any views, if you want to ping it into me, in terms of how you source. Do you automatically source free legals, or do you leave that one unticked so you can see a free legal and a cashback option? And certainly at the moment with Optima and Act, etc., how's that affecting your decision? I'm just curious to see some comments coming in on that. Now, somebody, we've got a hand up. Just wait for the microphone a second.
Yeah, Claire touched on discounted mortgage as well, variable mortgages. I've got a question surrounding SVRs. So what are the most important factors for lenders, and why when changing their SVRs?
What's the most important factors?
Yeah, when you change your SVR, what considerations do you make?
You look at things like where does that sit relative to some of your new business rates? Are you providing an appropriate level of value, what's the cost to service those. So typically people on that will revert and stay, because I think people might dip onto a revert rate for a short window of time, and then whilst they're sorting out whatever the next product for them is. But for almost what you would classify as like true back book customers, kind of LTV mix, loan balances, so a whole host of factors really to try and understand what does that customer component look like. And probably more and more, I mean, historically, revert rate, speaking from my experience, revert rates have probably been more linked to base rate movements, but actually there's a question to say, do we move slightly away from that? And that's something that we've been doing this year, to say actually we should be looking at these more in the rounds of actually what's available in the market, because there's sometimes we can, as we've known, we've been in a very inert, historically, base rate environment, and so there's probably been little movement, but we've seen a lot of movement this year because we've had multiple base rate rises. So there's probably a broader question around how should that work going forwards.
Okay, good. Happy?
Yeah, I mean, I was thinking, obviously as advisors, we're now considering discounted rates more probably than ever. And there's quite a disparity amongst lenders who've changed their SVRs, isn't there? So,
Yeah.
There are and not enough products available in the discount or tracker space yet.
Yes.
Let me just pop onto this. Yeah, curiosity then. So to all three of you, are you seeing more people pay an ERC to leave their deal early so that they can secure a new deal with yourselves, which obviously would exclude you, Reece, at the moment, before rates reach a peak? And is that something that's causing you concern, or you're just seeing that transaction happen?
Well, we've definitely seen an uptick in it. Previous to what, obviously quite a benign market previously. So there has been an uplift in it, but I mean, ultimately it's down to the advisor, the advice process to make sure that the customer's doing the right thing. You'd have to be, it depends on the size of the ERC, doesn't it, I suppose, and the rate you're on and versus the rate you're going to, etc. It's difficult to pigeonhole whether it's the right or wrong thing to do, but there has been an uptick in it.
Okay.
I would say perhaps maybe at the start of the year, as we started to see them increase, more of the uptick then. And actually what I've been looking at recently over the past few weeks, really small numbers now. And I wonder whether or not that's because people are thinking, the differential now isn't worth it, or could be not worth it. And actually trying to advise on that is hard, isn't it? Yeah.
Okay. Some of the conversations that I've seen within the broker discussion groups, so the likes of Cherry and other big broker forums that exist online, have talked about brokers in some instances almost doing like a parachute application. So they've done a remortgage application at, say, month -9, and then waiting for the product transfer window to open at either month -6, -5, -4, whatever, which potentially means that there's double applications in across the market. Any comments or concerns that you can share with us with regards to that?
So we've wondered this, but it's quite difficult to get. It's quite difficult, or we found it difficult to get any real concrete evidence of how much that could be. I expect that is happening and that is going on. But yeah, it's really difficult to be able to see, because you can only see obviously the applicant that's with you. I don't know whether.
Yeah, no, I was just saying you just don't. I think the difficulty from a lender point of view is you don't know what's live in your pipeline and what isn't, which presents challenges, because if you've got service issues as it is potentially, then you're processing more applications than you need to, which is a challenge. But again, as long as you're doing the right thing for the customer, it's the advice process falls on the broker, right? So.
And you regularly look at what's in the pipeline as well, and you make out those chase-up calls. Is this still going ahead? Is it still completed? We've done quite a bit of that over the past few weeks. We haven't seen, as a result, a massive level of drop-off, which is comforting from a lender's perspective. But equally, people that could be still hedging the bets?
Yeah, so within the discussion groups, when you're seeing brokers openly talk about these parachute, I don't know why they've been called that, parachute applications happening, completion dates probably won't be until like maybe Feb, March, April next year. What impact, if any, will that have on potentially surplus cash hitting the market next spring?
With decline rate?
As in, if you've got £100,000 mortgage, a remortgage, but only one complete, so it's either the PT or the remortgage. So there's double counting somewhere, so there ends up being spare cash in the market.
Yeah, and you increase the more funding available and more lending you want to do, you see increased competition, don't you? I suppose what will be really interesting though is if you think you can pre-book your remortgage a lot earlier in the process, now rates have moved up quite significantly. How much of the PT activity is going to go ahead? And if you're booking that at a much closer date, yeah, it's an interesting one. It's something that we're aware of and mindful of, but yeah, I'm not sure about volumes, and we're not too worried at this stage.
I think our world's slightly different, so we don't, we're a credit repair lender, so our most popular product has always been a 2-year fix. So product transfers isn't going to be sort of our forte, but it is interesting though. We have seen, I guess, over the rising interest rate market where people are trying to get an application in, and we have definitely seen now it feels back to stable, but there was a period there where it could take weeks to get documents in because people are just trying to get the rate in, they're trying to play the market. Yeah. So although not on the product transfer standpoint, definitely we've noticed that with the new business coming in.
Okay, and if I was to give all three of you a magic wand, imagine you're in your little Harry Potter world. If you could wave a magic wand, what's the one thing, quite quickly from a lender perspective, that you would like brokers to do differently? I'll start with Ben.
Wow. On the same topic, actually, it would be really helpful to know what is live and what isn't live in your pipeline.
Okay.
More so now than probably at any point ever. Historically, you'd say package your cases properly and get them to offer quickly and that kind of thing to help operationally. But I think given everything we've just talked about, it would be useful to know exactly what was going to complete or if it was going to complete.
That is a good point. I would say as well, just send what we need. Don't feel the need to send loads of documentation. Just please send what we ask. It makes it a lot easier to process, a lot more efficient. The more stuff that you send us, the more we have to look at.
Okay, Reece?
And I'm not saying brokers don't do that, so don't shoot me. Communication. So I think with us being a complex credit lender, look, you can put so much detail on the sourcing systems or the knowledge banks of the world. But there is a lot of stuff that we can, we could do the deal. So if you're confident to call up your lenders and run a scenario pass, there's a high possibility we could do the deal. Or just to give us an example, if in our space we sort of cascade up a lot, if that makes sense. So we've looked at some stats of our I guess decision and principles that come through, and we have like a tiering system depending on the severity of the complex credit. And we noticed that 30%. If a case came in on, say, a level 2, 30% of that went to offer would actually go up to a level 1. So we were able to manually look into that deal and see, actually, on completion, this will fit here, and we can actually move it up the ladder. Now that's a prime example of something that you're not going to see on any sort of knowledge bank or any sort of sourcing system. So if you can be confident to communicate with your lender and run the full deal, and as it sits, there's a high chance you could be sitting in that 30% that actually got their customer a better deal from when the decision principle came into the offer got processed.
Okay, so with you guys, it would be to ring up and have the conversation.
Well, ring up, have a relationship. I mean, look, we're pretty proud of our sales team to have a relationship with them, but don't be afraid to ask something that just looks like black and white. It's not within policy because specialist lenders, we are trying to adapt and make the deal work.
Okay, so a couple of real quick fire ones then, because we've only got 2 or 3 minutes left on this session. As lenders, are you overly bothered about estate agents requiring decision in principles in advance to enable somebody to even view a property? So potential for unrequired dips hitting your system.
No,
No?
not for us, not for us.
Not bothered.
Soft credit footprint, a dip,
Yeah.
means that we're probably not bothered, but it's still got to be the right thing for the customer. Right?
Okay.
Echo,
Same.
yeah.
Yeah. Okay. Cool. And then last one that's coming from the audience. Any concerns from a lender perspective about cost of living, the pressure on families, and leading to people cancelling any protection they've got in place to support the mortgage? Does it come up in discussions or not really, as you're not protection providers as well?
So no, it doesn't come up in conversation, but equally, I think it's obviously, we'd like all of our customers to be properly protected,
Yeah.
obviously,
Yeah.
but it's a
Yeah.
difficult one when you're an intermediated business to challenge or have a conversation about because,
Yeah, I'd echo that. I think it's not come up in conversations in terms of a big discussion and topic area. It has been something that has been mentioned. And I'd echo that really you wanting people to protect their interests, protect the mortgage.
Okay, very good. We're out of time. My light has gone red. Thank you very much for your attention today. Thank you very much, members.
Thank you.
thanks
Cheers.
everyone.